I think lots to talk about in terms of tokenizing real world assets, debt, equities, other things. Also, the underpinnings of crypto behind commerce. But what I want to start with is OpenAI and Robinhood. So, give
Yeah.
some context. What happened there, and what do you think are the most interesting elements to unpack?
This all kind of happened at the ETH event, the ETHCC event in Cannes, where Robinhood announced that they are now launching a platform. The platform is based on Arbitrum, which is a layer 2 rollup for Ethereum. So effectively on Ethereum, you can now trade tokens, and that the particular token that they're launching is OpenAI private equity. So essentially, this is like super viral moment because you've got people getting excited about like now we've got equities on chain. You have other people excited about you can trade OpenAI. It's not on the public markets, but here now it's on the token markets. You've got the Ethereum people excited because it's Arbitrum, and it was this like amazing moment. And then the next day, OpenAI comes out and says, "Actually, we never gave you permission, and you can't trade OpenAI equity at all." And so, the interesting part that kind of opens up is like, how did they put it together? And the answer to that is it's a derivative. It's effectively a contract for difference or perpetual.
Well, let's just back up a little bit because I think, like, first, the big thing here is that Robinhood now lets anyone on their platform, actually not anyone, 150,000 people in Europe trade OpenAI, which is a token of an SPV, but they can kind of like trade that thing. So that's interesting, but it's not allowed in the US. I'm also curious about like the regulatory layer, like why is this in Europe? And then we can get all the way down, I think, also to the tech layer, which is what you started talking about with like, Arbitrum and Ethereum, and the extent to which that tech layer versus the regulatory environment versus the distribution is kind of the key story here.
Yeah, I mean, this is a topic that's hard to do by just focusing on today. Like, I have literally 7 years of scar tissue that the bile of which comes up. You know, when you say regulatory, I just feel cold all of a sudden. So, security tokens are a theme in crypto that's been around since 2018. And largely, they were a reaction to initial coin offerings. Initial coin offerings are the thing that made Ethereum popular. And it was sort of like crowdfunding of these tokens on a blockchain as the market venue rather than having every coin be separate and independent on different chains. And then people lost a lot of money on that. And so the reaction from finance people was, of course, you lost a lot of money on that. It's all fake. All these ICOs are scams. Same thing that people are saying about tokens and meme coins today. And so the right answer is that we should bring equities on chain, and instead of trading, whatever it is, Solana or any of these tokens, what you should be trading is stocks. You should buy Apple stock, Tesla stock, OpenAI stock, and so on. And so people tried that in 2018, 2019 with security token offerings. It didn't really work for a bunch of reasons. Then we tried it again with enterprise blockchain, with JP Morgan, with UBS, with all the large investment banks kind of in the 2020 arena. It didn't work for a bunch of reasons, although more got done. And now we're trying it again, but on public permission chains and with fintechs. And the excitement here is that fintechs have this enormous distribution, and the tokenized equity that they're bringing to market is interesting to people. Now, to your point about regulation, what actually is going on here is kind of it's not really a private market for secondaries the way that you would maybe trade on Forge or on Hive, right? So you're not actually like trading in a legal contract. It's much more like a derivative, and that's effectively what this Robinhood product is. The tokenized bit is just a like a hyperlink to this concept that is then able to participate in on-chain markets, which are now performant enough to actually be delivered by a fintech.
Yeah, and history doesn't necessarily repeat, does it? but it does rhyme. And we have stories of Eurodollars, basically Europeans using US dollars post World War II for part of the recovery efforts. Also stablecoins, like a lot of the uses in Tether and Circle, also people holding them internationally because of the regulatory context here is not so great or supportive to these things. What do you think is the story in terms of the actual technical level here in terms of what they've done versus just retail sentiment bringing this stuff back online again?
Yeah, so I mean, I don't have a deep view into their architecture. I have just a market understanding of it. I also have about 4 years at Consensus trying to do digital assets, where we worked with like every single large bank you can name. And like today, anyone, you or I, can go on a Solana-based platform or a Coinbase-based platform that is called some sort of token launcher, as pump.fun or something on Base or whatever. And we can launch a meme coin. And the reason it's a meme coin and not a security is because it is empty of sort of substance. Like it's a shell, right? It's a shell that's meant to stand for something. Maybe we go on Twitter and promote it, but it doesn't have underlying cash flow or any sort of economics. Alternately, you could imagine a world where OpenAI is like, I want to tokenize my equity, or there's actually a bunch of crypto treasury companies that are working with Superstate, Rob Leschner's company, to tokenize their equity. In terms of the technical answer to your question, Robinhood has its own chain, which is a private label, let's use an old term, of Arbitrum. Arbitrum is one of two technology companies, really protocol companies, that have created scaling tech for Ethereum. Arbitrum and Optimism are kind of the main two. There's a bunch of others, but those are the main two that people talk about. And one of the things that Arbitrum does is enable other companies to create their own chains. Coinbase did the same thing. So Coinbase's base chain is based on Optimism. Even Binance has its own chain, BNB. It's a little bit more custom and it's a side chain, so like a older technology. But nonetheless, exchanges often have chains because that's a interactive market venue on which people can do capital markets and payments transactions. And those chains have the potential to have KYC and permissioning around them.
Yeah. I think there are some interesting things on the infrastructure side for how they built it. Vlad has a tweet showing like, here's the hash of the transaction I did live at the demo. That's cool. That's something you can't really do and demonstrate for our traditional clearing systems. And that's interesting.
I've been
but
really
I think
focused...
the bigger story is just Robinhood has 15 million monthly actives. They're one of the biggest day trading platforms out there. And the infrastructure in crypto has evolved such that they can do this private label type product on top of it. They probably could have done it without crypto at all, to some extent, it's a marketing thing in addition to some of the infrastructure. But, over time, maybe that infrastructure will show that it has real value to the user. I want to move on to the OpenAI question, because this is, I think, one of the interesting angles of this conversation is like, who has the rights to determine what should be traded and who allows you to trade it. And so OpenAI, their tweet is, these OpenAI tokens are not OpenAI equity. We did not partner with Robinhood. We were not involved in any of this. We do not endorse it. Any transfer of OpenAI equity requires our approval, and we did not approve any transfer. So that's their stance is like, this is fake. Also, caveat emptor. What is your perspective for these late stage private companies in terms of who should be allowed to trade them, both from like which regulators should say like, the public can trade these things and the extent to which companies, whether they're private, not private, should also allow people to trade I have my own opinions here, but but I'm curious to start with where your head's at.
Yeah, I am such like a radicalized person on this question. I started my career at Lehman and with a very traditional finance background. To some extent, it just doesn't matter. We can try to create rules or paint these stories however we want, but in the end, people are just going to do what they're going to do. I think there's a real problem between public and private markets, and the problem is that the public markets are no longer the place where companies go public. It's not the place where people go to raise capital. It's the place where people go to cash out. So once a company's been successful and has raised its capital, it comes to IPO in order to monetize and leave. Effectively, so OpenAI being worth 300 billion, Anthropic being in the whatever it is, 50 to 100 billion dollar range. A lot of the good companies don't want to be public, and for a number of reasons, whether it's the compliance cost or the reporting or just the fact that it's really easy to get lots of private equity to invest in you, and also it's valuations in the private markets are much higher. It's easier to be valued more highly in the private markets. And on top of that, you can get liquidity for your employees. Lots of people, sell secondary on the private markets. So then the question is, what are the public markets for? And I think that's an increasingly difficult question because it's not necessarily for speculation. Like crypto infrastructure now for many, many years is able to support speculation through derivatives in a product called perpetuals without any ownership or custody of the underlying stuff. So to exclude private equity from the everything is financialized bucket just doesn't make any sense to me.
Yeah, I think I'm pretty aligned. Actually, I thought there'd be more points of discrepancy, but water wants to flow. It's like an inexorable force of nature. Things want to trade. That's inexorable force of markets, even if things aren't listed. And you can try to stop things from trading, but the reality is you just create a weird alternate universe that kind of ends up being worse than letting them trade.
Yeah.
And right now, if you look at like the if you've seen the tweets about like the layered SPVs that people are doing in OpenAI equity or in SpaceX, like that's complete garbage. And if you're a $300 billion, market cap company, like you already have a bunch of equity holders. I think one way I think about not letting things trade is kind of like rent control for private assets. Like it sounds good. It's like the insiders are protected. You have control. But really what it does is it just kind of freezes your city in Ember. It freezes your markets in Ember in a way that you lose the access to information because that's what markets are, is they're like information digesting and producing machines. And so you lose that. You also just have all these weird workarounds that evolve. And so, I mean, this is 150,000 Europeans can trade OpenAI equity through Robinhood under this regulatory framework because we haven't figured out a way to actually let things trade. Now, saying that is a lot easier than letting it happen and getting regulators on board. So I'm not saying that this is easy or trivial, but the alternatives often seem worse.
Yeah, I mean, the OpenAI tweet is written by its lawyers to protect its contracts. It's not actually directed at Robinhood to stop doing what they're doing, and it's not actually directed at consumers who want to speculate on bad products.
Yeah. If you're a consumer, I'm curious, and you're not just someone who wants to speculate, but you care about long-term enterprise value creation. I'm curious why, what should you be paying attention here? Because I think right now, basically what it is, 150,000 Europeans can trade this thing. It's thin float, so it's tangentially connected to OpenAI, but it's really just a meme thing. Because with that narrow of a float, it can't actually represent, and that narrow of an audience, it can't actually represent the underlying equity value. So, what should you care about from this announcement?
I think the thing to take away is that fintechs have finally converted to using crypto products. So my very simple model for all of this stuff is that Web2 fintech is distribution. It's the store that sells sandwiches. And for a long time, the store has been forced to sell sandwiches made by investment banks and asset managers and core banking systems and portfolio management systems and payment networks and all this stuff, right? Because the store can only stock what's coming from the factories. And we have old factories. And so Web3, more broadly, is the new factory. And decentralized finance has been a bright example for the last 5 years of what finance is actually going to look like in the future. But not like finance distribution, because we know what finance distribution looks like, and that's Revolut, Robinhood, Stripe, Coinbase, and so on. Maybe Anthropic, we'll see. But the thing they're going to distribute is crypto native products, and so fintech is there. Stripe is there with the acquisition of Bridge. In my mind, Coinbase has been behaving like a fintech. SoFi is there. Robinhood, Revolut are there. It's happening. So the hundreds of millions of users that fintech has pried out of the banks over the last 15 years are now going to be exposed in a very seamless way to crypto native products. And those products will be obscured in a way that normal people can't tell the difference and shouldn't know the difference. So for me, that's the exciting bit. Something like 20% of the world economy is financial services, and financial services is there to help people pay each other, to help people borrow money, do intertemporal risk transfer, and then more complicated stuff on that. And so I think if you look ahead, it's always interesting to catch the trends, like what people are buying and what the platform is underneath for financial systems. So every time we switch how commerce happens, we also switch the payment processor. So e-commerce brought its own payment processors. Once we entered the Web 2 era, where everything needed to be through APIs, Stripe brought its own payment processors. Proximity payments, once we could use our phones for commerce and so on. So I think that leads the development. And the kind of the interesting battle that's been set up is Coinbase versus Stripe, where both companies are entering this really frontier part of the market, which is this combination of AI agents, payments, and commercial activity. And as far as I can tell, they're the only two companies that are doing it seriously. So,
and I think maybe to set some historical context too, a lot of people would say the historical original sins of the internet are no internet native identity and no internet native payments. Stripe came along, they said, hey, we'll make it really easy to bring cards online. That's not internet native payments, but we're going to connect existing payment infrastructure and rails, bring it online. Awesome. Built a really great company, helped a lot of people build really interesting businesses, and helped places like Shopify get started. But now we have Stripe and Coinbase thinking about, okay, what would it look like for us if you're Stripe to kind of retailer our platform to internet native payments? But Coinbase has an even more slightly orthogonal approach, and they've called it 402, which is the return code for payments that was never actually implemented in the HTTP protocol. So anyways, with that context, talk through kind of the two Stripe and Coinbase approaches in terms of how they're trying to enter this new era of payments.
Yeah, so the 401 is I think the website's not loading, it crashed, your website's not there. And then 402 is supposed to be this pop-up effectively being what internet payment protocol do you want? And it's haha, there is no internet payment protocol because the internet's for media, and it's a hellscape of algorithmic content that's meant to get you to eat advertising all day long. And that's what Web 2, this sort of where I go into the Web 3 religion, the Web 2 original sin is lack of digital scarcity, a lack of ownership, lack of any sort of integration with economic systems. So you end up being in this completely sort of shallow slop media world where the only economic model is advertising. And so the other point on Stripe is they built an amazing company, and they're really great product builders and incredible entrepreneurs that I admire very much, that have effectively put Scotch tape on the old factory, right? Like I started saying, fintechs they're the store that's distributed the old stuff, and it's exactly this point. You're shoving 2.5% Visa into internet payments, which it's great. There's a ton of commerce that grew up on it, but what we have now are stablecoins, and stablecoins are just crypto dollars. We can talk about how they're made and the different ways in which they're made, but crypto dollars are dollars, and they're on the internet, and they're digital, and they're scarce, meaning if I give you my crypto dollar, you have it and I don't. And that's exciting for these companies because they can redistribute, they can use their distribution footprint to power commerce, but using the modern rails. Now, the kind of the fanciful part of the story is this idea that like human e-commerce is saturated with the old solutions, and let's not like there's lots of companies that are working on transforming payment orchestration and so on, but instead, if this is the modern financial system and a lot of the future GDP of the world is going to come from artificial intelligent agents, that you're going to have software do things on your behalf. They're going to go shopping for you. Yeah. They're going to build products for you, which is already true. They're going to go be your avatar on TikTok and monetize and then buy your sandwiches, whatever it is. Then you need a financial system that's positioned ahead of this agentic commerce shift. And so both Coinbase and Stripe see this and have been working on APIs for AI agents that enable machines to, at machine speed, very quickly, automatically, with no human check, with no sort of intermediation, to perform transactions. And so Coinbase has an AI agent API that gives AI agents wallets and the ability to use stablecoins. And then this 402 initiative, I think, is a way to kind of shove permissioning into their browsing and interaction with the web. So if I'm a robot and my job is to get sandwiches every day, and I go to Deliveroo and then I try to pay Deliveroo, instead of using the buttons, the robot can just say, hey, like I'm on the internet, let's use the 402 protocol to move any sort of payment processing around. And then Stripe is looking at the same problem from their perspective. They now have a stablecoin company in Bridge. They have a wallet company in Privy. And they are, again, trying to preempt this platform shift away from them by building the stuff out way before there's any sort of product market fit. But 2 points makes a line, so I'm excited to see both of these companies trying to do it.
Where I feel like we are is we're in this primordial soup where you have all the elements where this could come together and become really interesting. And then the thing that's brand new is you finally have a channel like a Coinbase Shopify partnership that could push it out. Coinbase, I don't know how many millions of monthly actives they have. Shopify, though, runs like hundreds of thousands of websites. So you finally have like the two distribution channels come together. So that's cool, but it's also, I feel like, kind of the same story we've been hearing from crypto for the past 15 years. Like, look at these like fun things we could do, but there was never the connective piece. Now it's been like 15 years later. Maybe this time it's different. And I think it's mostly because the Shopifys and the Coinbases finally have scale where they can push through and actually get these like toy things out in the real world doing real things. But I'd say we're still like, maybe this is the question, like where do you think we are in that journey now for this like internet? Are we 50% there? It's, almost fait accompli. Is it, to me, it feels like 1 or 2%. Because we're finally 15 years in the crypto economy starting to connect. And I don't mean this too derogatorily, like the fake crypto world to the real world. And so we're like kind of 1 to 2% on that journey.
There's nothing wrong with 1%. Amazon has, I think, like 15% of commerce. Versus, all terrestrial commerce versus e-commerce is still, in the single digits or the 20%.
I think the pandemic is when it switched from 50-50 e-commerce to not e-commerce.
Unless
like
it's China. In China, it's like
categories
70%, right?
Yeah.
I mean, there's a lot of detail in regards to crypto that I will avoid and just say this. Ethereum is a 2016, 2017 phenomenon. Bitcoin is a 2009 phenomenon. So there's been 15 years of Bitcoin. Bitcoin is a volatile asset that is largely a macro asset and a sort of like a religious investment. It has performed its function relative to fiat and performed as gold does. It is not fit for purpose for payments. It's not a payment instrument. It's not fast enough. And sometimes the answers are simple. Like there were payment processors that tried to use coin networks at the time, altcoins, 2013, 2014. Those things were volatile and slow, and so they didn't work.
Yeah. You can watch the original Coinbase YC pitch online. It's all about Bitcoin for payments.
Because payments is almost irrelevant in the Coinbase economics. Like trading is...
It is irrelevant. Yeah.
But the fact that they care about commerce and payments means that they care about the fundamentals. And I think they're one of the few. Anyway, so the transition's been from Bitcoin to, as I said, stablecoins, which are crypto dollars. So now you have just dollars on chain, which removes the question of like, how do I sell the crypto and settle it and who custody? It doesn't matter. It's just dollars. And then number two is the transaction systems are fast enough and secure enough to actually process commerce at sufficient scale. So, those two things are done. And so it's not a surprise that we see their usage.
Yeah. I think my favorite example for thinking through the 402 protocol from Coinbase is, like, let's say you have a dispute versus the happy path. So even the happy path is a little bit better when you go to checkout as a consumer. Like right now, you swipe your card, it like kind of settles instantly, but it shows up as pending on your statement for a little bit, and then the merchant gets the money like a day later. It's like, that's pretty good. But the approval or not, that happens super fast. That's amazing. That's, Visa in the background. But then you go to return something, and it's like this really convoluted process. And it can take like 13, 15 days, even after approval, for the money to show up on your statement. With something like 402, you can have, just spin up a new wallet or an account on the ledger. That ledger can basically be an escrow account. You can have MCPs interacting like, oh, did the package get delivered? Okay, it did. Great. Release funds. Oh, wait, there was an issue. Consumer uploads thing. Another agent, digests it, says like, okay, this meets our policies. Goes back into escrow. Like, you can figure out how to do stuff in a way that's just fundamentally better. But we're like so early there in terms of, because we've actually got to get this stuff out in line.
Yeah, I mean, there's a broader point, and the broader point is when blockchains are computers. Computers can run software. You can call them smart contracts, whatever, but computers can run software. So blockchains can run software, and the entire state of the blockchain syncs to whatever the software says, right? And it's immutable in the sense that you can't mess with it. Like you have to. It's very expensive to attack. And because of that, the example you gave and literally the other 400 examples are just going to be put into software, and everyone can use them. And that's it. Yep. They're not proprietary. They're not a competitive advantage. It's a nothing burger. That they're giving it away because this isn't valuable. This is like a basic internet right, And that's kind of the magic of the approach that blockchains bring to financial services. And I think the opposition to these points, it's like some people really enjoy saying like Elon Musk is so wrong on self-driving cars. You are like, whoever's saying that is wrong, right? Like they're clearly wrong. Like we are on a path to self-driving cars. You've got a huge AI boom that's doing completely magic things. So obviously this is going to happen to money being such an easy problem relatively. And so, it's so blindingly obviously better that it's not even like it's amazing to me that there's kind of like pushback of why do you need it? Because obviously when you're in the computer world and you can write software to solve any of these problems, like is just profoundly better. Yeah.
And how this is getting built is really messy. And I feel like this conversation was kind of like a messy sense-making conversation. And on one hand, you're like, oh, that's terrible. Like, it should be clean. It should be obvious. But then you go and you read financial history and you learn how, like, our equity markets and exchanges got built up, and it involves, like, the DTCC and the paper crisis in the 1980s. And you actually don't own stocks. They're held in a centralized registries. And then there's, like, these four intermediate. All of this stuff is messy. Even like the world we live in today.
None of your financial products you own, and this is at the root of the point too, which is like it's you.
But you don't care because we figured out how to build those abstractions correctly, right? Like the system works. It's just a clutch or kludge. Yeah.
I think you do care. I think I care now, and the reason, like, my career started with Lehman Brothers, and I care about the custody of financial products and counterparty risk because it's the formative, it's like my formative experience. You know, I also grew up in Moscow with hyperinflation until I was 10 years old. And so, like, these are, I'm not saying you're framing it differently, but
it
like,
doesn't matter
are,
until it does. Like, Robinhood
and,
almost went under because securities settle in T+3 at the time. And then after like 15 years, they got it to T+1. And now there are working groups to get it T+0, which, to your point, if things don't settle immediately for those 3 days, you have a lot of counterparty risk.
Yeah,
really
you had like a shareholder who like came in with whatever it was, $300 million he happened to have, you know, but like, why? But anyway, my point is that, like, yeah, the crypto people will sound insane, as I probably do, but and it's not about being prescriptive that everyone needs to have self-sovereignty or everyone needs to be permissionless or non-custodial. It's that you can choose to be so, because custody is convenience, but custody is also Madoff. Custody is FTX. Custody is when you trade for convenience the ownership of your stuff. And then you have principal agent problems. So if I'm like, Rex, you look like you're fantastic at money management, here's some money, then we need the state, the regulator, to come in and prevent you from being bad about it. Like, you have to be a fiduciary, you have all these duties to me, they're legal, enforceable, and so on. The problem isn't the state or the regulator being inefficient. The problem is I give you my money, right? Like, I made you an agent, and now you're in custody of my stuff, and now you have incentive issues, right? And therefore, we need to bring in all these incentives and regulations. One way to back out of that is to avoid the custody issue, right? And be to be self-custodial. And that's kind of what crypto brings as an option, not as a requirement, but as an option. And I think that's the powerful thing.
Great conversation. You now started a venture fund. What's the story there? And also, where can people find you online?
I do have a venture fund. So it's called Generative Ventures, genventures.xyz. We invest in the machine economy. So a lot of the themes that I've covered, we believe the world is going to be AI first in terms of GDP creation, and the financial systems underneath are going to be new and different. So we're looking at crypto AI, we're looking at DeepIn, we're looking at protocols, financial applications, DeFi, sort of all those sectors. Other than that, I also write a newsletter called the Fintech Blueprint, and try to make myself easy to find on Twitter and LinkedIn.
And that's super easy. I think lex.substack.com will get you there, or fintechblueprint.com will get you to both of those places. Awesome. Well, thanks so much for coming on, Lex. Maybe we'll have to come back and talk about where crypto is once merchants are using 402 from Coinbase, and once tokenized equities are available to maybe 10 million instead of 150,000 folks. Through a retail, distribution channel. Obviously, if you're like a little more entrepreneurial, you can do it today. All right. Thanks for coming on, man.